In a world where change is the only constant, Mo Shamil stands at the forefront, guiding title professionals to not just grow their businesses, but to master the art of innovation. With every episode, you're handed the keys to unlock unparalleled growth and stay ahead of the curve. Get ready for a transformative journey.
Welcome back to the Deep Dive. If your job has anything to do with U.S. commercial real estate, you know the feeling. You're trying to figure out what's coming in 2026, and you're just drowning in reports.
Well, completely. It's an avalanche of data.
Yeah, you open up, say, a CBRE report, and it gives you one angle on the industrial sector. Then you jump over to JLL, and their take on logistics is, slightly different. And then NAIOP comes along with this, frankly, depressing deep dive on office space.
And just when you think you have a handle on it, the finance people at the Mortgage Bankers Association, the MBA, drop their own numbers on debt.
Yeah.
It's not one forecast. It's like 9 different conversations happening in 9 different rooms at the same time.
Exactly. And if you try to read them all one by one, you don't get clarity. You just get analysis paralysis.
You really do.
So that is our mission today. We've taken 9 of those major sources, CBRE, JLL, NAIOP, MBA, NAR Commercial, and then key publishers like Globist, Bisno, Commercial Observer, and CNBC. And we're going to synthesize them for you. The goal is one clear, unified picture of where the U.S. CRE market is actually heading for 2026. Okay, let's unpack this.
And I think the real value here is that synthesis. We're trying to move beyond just one headline, whether it's optimistic or pessimistic. We want to get to the consensus, right? But also see where the experts disagree, and this is the crucial part, connect the dots between the buildings themselves and the money that funds them.
Right. And we're going to tackle this thematically. First up, we'll hit the foundation, the capital markets, and the debt environment.
Where the deals start.
Exactly. Then we'll dive into the sectors, the winners, the losers, what's happening with space, and finally we'll look at the big disruptive trends, things like tech and ESG that are changing the game permanently. So let's start with that foundation. Before we even talk about a single building, we have to ask, what is the money saying?
Well, the consensus from the finance side, and this is pulling from the MBA, NAR, Globus, CNBC, it's uniformly clear. Debt, the availability and the cost of debt is still the single biggest factor for 2026.
Okay.
The MBA forecast for commercial and multifamily finance, for instance, it puts a really stark number on this. They're forecasting a continued restraint in loan origination volume.
So it's not just that interest rates are high.
No, it's more than that. It's that lenders are being incredibly selective. Their appetite for risk is just way down.
So if the volume of new loans is down, what does that really mean on the ground? It's not just about stopping new construction, is it? It sounds more like a problem for buildings that already exist.
That's it. You've hit it exactly. That is the thing executives are losing sleep over, according to the roundtables in the Commercial Observer. The whole debt environment is being dominated by this maturity wall.
The maturity wall, right?
It's this huge wave of commercial debt that was taken out years ago when money was cheap, and it's all coming due now.
And with rates so much higher, refinancing is a nightmare.
A nightmare is a good word for it. For a lot of properties, it could wipe out all the equity, maybe even force a sale. That refinancing pressure is the #1 risk factor everyone is talking about.
So the big question isn't, can we build something new? It's, can we even afford to hold on to what we already have?
That changes the entire game. And you see it in the investment trends NAR Commercial is reporting. Investors are pulling back from anything that looks even a little bit weak.
So sentiment is shaky.
It's, I'd say, cautiously optimistic, but intensely selective. Globus says they're demanding absolute clarity on the yield before they'll even think about committing capital.
And that search for clarity brings us to the one metric that shows up in almost every single source we looked at: cap rates.
Cap rates are everything for 2026. They're the essential barometer.
Just as a quick refresher, that's the property's income divided by its price, right? It's the return an investor expects.
Exactly. And both NAR and Globus are hammering this point home. When the cost of your debt goes up, the cap rate has to go up to justify the purchase.
Which means the price of the asset has to come down.
It has to. And that adjustment is happening, but it's slow. It's uneven. And for some asset classes, it's, frankly, painful.
And if it happens too slowly, the market just freezes. No one's buying or selling.
Correct. The whole investment climate really hinges on how quickly and realistically those prices adjust to the new cost of money. That's the scene setter. Tight money debt worries, and very, very picky investors.
Okay, so that takes us from the ledger to the lobby. Here's where it gets really interesting. Let's talk about the actual buildings, the sector deep dive. And we have to start with the elephant in the room, the office sector. It is by far the biggest challenge facing the market.
Oh, without a doubt. It's the most polarized sector. And NAIOP's forecast on office absorption really spells this out. You're seeing these little bursts of leasing, but it is 100% for the brand new, top-of-the-line, amenity-rich buildings.
The flight to quality.
The flight to quality on steroids. For the rest of the market, the older buildings, the outlook for a broad recovery is deeply challenged. This isn't just a normal recessionary dip. It's a structural change.
Driven by the one thing we can't ignore, the impact of remote work. When you put the Commercial Observer and NAIOP sources together, it's clear this isn't a temporary blip. It's fundamentally splitting the market.
It absolutely is. The whole conversation has shifted. It's not about how many square feet a company needs anymore.
It's about what the space does.
Yes, what it does. Companies are using their lease renewals to shed all that extra space, but at the same time, they're upgrading to much, much nicer buildings. The office has to be worth the commute now.
And that means the best-in-class assets are okay, but there's just this huge shadow inventory of older, empty space with no clear future.
A massive shadow inventory.
That makes perfect sense. The office market is sick, but it's also being forced to evolve.
Okay, let's pivot. What about the other core sectors? They're not immune to debt costs, but the picture seems more stable. Much more stable, or at least predictable. Let's start with industrial. For years, it's been the market darling.
Still is.
It's still strong, but the sources, especially CBRE and JLL, are pointing to a key shift: moderation. The fever pitch growth is normalizing.
But demand is still there, from e-commerce, reshoring, all of that.
Demand is definitely still there, but supply is finally starting to catch up in some of the really big markets, so you see absorption slowing down just a little bit.
So it's moving from explosive growth to just sustainable, healthy expansion.
Exactly. And the growth is getting more specific. It's less about generic warehouse space and more about these highly sophisticated, high-tech logistics hubs.
Okay, what about multifamily? People always need a place to live, but are the high debt costs finally starting to light?
Multifamily is still very attractive long-term, but the NAR Commercial data adds some important nuance.
It's not a monolith.
Not at all. National demand is solid, but if you look at certain high-growth cities, especially in the Sun Belt, you're seeing some temporary oversupply from all the construction a few years ago.
So returns are getting squeezed in those specific areas.
They are. It's still a good sector, but it's become a game of inches. Operators are focused on managing expenses and keeping tenants, not just banking on huge rent hikes every year. It's become a hyper-local game.
And retail. For years, it was the problem child, but it seems to have found its footing.
Retail is a great comeback story, isn't it? It really is. JLL's outlook confirms it. The sector adapted early to the e-commerce threat. Experiential retail, necessity-based retail, it's doing really well.
So places you can't just replicate online.
Precisely. Well-located mixed-use centers are thriving. And foot traffic in places like grocery-anchored shopping centers is surprisingly strong. It's a steady, stable sector now.
Okay, one last one here. JLL made a point of calling out the life sciences sector specifically. Why does that deserve its own category?
It's a really smart distinction because life sciences, real estate labs, research facilities, it runs on a completely different engine.
Not the traditional economy.
Right. It's driven by venture capital, by NIH funding, R&D budgets. So it's largely disconnected from the typical economic cycles that hit office or retail. It has its own demand drivers, which makes it incredibly resilient right now.
Okay, so we've got the capital constraints and the performance of the assets. Now, let's talk about the big picture forces that are changing everything, the non-cyclical factors. Let's shift to disruption.
Yeah, and this is where it all connects. This is about the macro drivers that are fundamentally changing the function of real estate, no matter what interest rates are doing.
So, looking at Bisno, Commercial Observer, and CNBC, what are the biggest disruptors that owners need to be thinking about for 2026?
Well, number one is emerging technology. Bisno details this really well, and it's so much more than just, smart locks on doors. We're talking about AI and data analytics getting baked into how buildings are operated, how space is scheduled, even how they're built.
And that tech drives efficiency.
It forces efficiency, which means companies can use less space or at least use it more intentionally. The kind of optimization we've seen in logistics for years is now coming for the office sector.
So tech is a double-edged sword. It drives down demand for generic square footage, but it also drives up demand for that super high-tech premium space.
That's the dynamic, exactly. And the other huge factor is ESG.
Environmental, social, and governance.
Yeah, and Bisno and the Commercial Observer both highlight this as a critical gatekeeper for institutional money heading into 2026. This isn't just about ticking a box for compliance anymore. It's becoming a deal breaker for big investors and a major preference for tenants. Older, less efficient, so-called brown buildings are facing a serious risk of becoming obsolete.
Because the big funds simply can't or won't invest in them.
They can't. Their own rules won't let them. So that shrinks the pool of potential buyers for that building, which crushes its value. It creates that same two-tiered market we talked about in office, but based on a building's carbon footprint.
Wow. So when you combine the data with what executives are saying, what's the strategy?
The smartest players aren't just sitting around waiting for the market to recover. They're being surgical. They're identifying those older assets and making a call, modernize it, tear it down, or reposition it entirely to meet those ESG standards.
So they're taking those big macro trends from CNBC inflation, labor markets, and they're applying them with a magnifying glass to specific assets in specific submarkets.
That's the only way to win right now. The era of a rising tide lifts all boats is over. It's about finding those pockets where demographics, tech adoption, or ESG compliance gives you a real edge that can overcome the high cost of capital.
We've covered a ton of ground. We started with the tight financial conditions, the debt, the cap rates. We moved to the structural challenges in office versus the stability in industrial multifamily. And we just wrapped with the game changers, tech and ESG. So for you listening, you should now have a really consolidated view of the finance, the sectors, and the disruptive forces that are shaping CRE in 2026.
And I think the power of doing this synthesis is seeing that consensus emerge. When you have CBRE, JLL, and CNBC all pointing to tight capital and this intense focus on premium, future-proof assets, that's the reality. We've managed to cut through the noise of 9 different reports to find that single, unified story. And that story is all about selectivity and quality over quantity.
So what does this all mean?
I think it means you need to start thinking about how the convergence of remote work, which NAIOP laid out so clearly in Emerging Technology, from the Bisno reports, is basically breaking our old ways of classifying real estate.
You mean going beyond the simple labels of office, industrial, or retail?
Precisely. Those traditional buckets are becoming less and less relevant. The real question for the coming years is about the underlying function of the space. Is this a space for collaboration? Is it for high-tech robotics? Is it for last-mile delivery? Is it a specialized wet lab for R&D? That functional definition is what will determine value and risk, not the old label.
So as an investor, you have to look past the sector title and analyze the actual use case.
That's the thought I'd leave everyone with. Your analysis has to be based on function now, not just form. That's the big shift.
In a world where change is the only constant, Mohs Shamil stands at the forefront, guiding title professionals to not just grow their businesses, but to master the art of innovation. With every episode, you're handed the keys to unlock unparalleled growth and stay ahead of the curve. Get ready for a transformative journey